Everyone's freaking out about tariffs today. NASDAQ's down 1,000 points, over 5%. People are getting nervous. If you've been watching my videos, you know that I have been forecasting a recession for a while, so there's no surprise here with this market action, at least not to me. But let's talk about how we can make money and be a winner in the long run in this uncertain environment, specifically when it comes to stocks. I think there is a great opportunity with industrial stocks if the tariffs work as designed. If we do get a recession, industrial stocks are going to get hit. They're going to go lower from here. So this is a long-term investment idea. You need to be thinking 5, 7, 10 years down the road, past a recession or a potential recession if we get one, and well into the recovery. That's where you're going to make your money. I don't know where the bottom is. We could go a lot lower from here, but we want to start thinking about what is going to be a winner over the next 7 to 10 years. And I think it is industrial stocks. I'm going to show you some holdings in the XLI ETF. We're going to take a look at their market caps and then compare them to the absurd market caps of the Magnificent Seven. For those of you who watch my channel, you know that last year and a few months ago, I was saying the Magnificent Seven were a bubble, grossly overvalued and ripe for a decline. Well, the decline's here, and I think it can get a lot worse for the Magnificent Seven. So I wouldn't be betting your retirement nest egg on the Magnificent Seven and thinking you're getting a deal. You need to look elsewhere, and I think industrial stocks are the opportunity. XLI is an industrial-focused ETF. It's been around for a long time, since the late 90s. It's very cheap, only 8 basis points. There's $20 billion in the fund, and it has a dividend yield higher than the S&P 500 at 1.52%. The historical max drawdown on XLI was over 62%. If we get a recession, this investment can definitely go down. It can go down quite a bit. Again, I'm thinking about the long game for tariffs and industrial stocks. Here are the market caps for the industrial stocks in XLI. This is something that I get excited about. When I look at this and I see that GE Aerospace is only $200 billion, or Raytheon is $176 billion, Union Pacific $137 billion, Deere $123 billion. These market caps are tiny compared to Apple at $3 trillion plus, or Nvidia when it was over $3 trillion, or other companies that are $1 trillion plus. All the Magnificent Seven stocks. I see opportunity for growth here just on the market caps alone. Now the relative numbers like the PE, little high, 27 times earnings for the top 60+% of the stocks. It's not as cheap as I would like it to be. The dividend yield 1.6% for the top 60% of the stocks, also not exceptionally high. But if the tariff policy works, you could see these numbers improve. And also, if we get a recession, then I would expect the stocks in this ETF to go lower, and you could buy them at cheaper prices. And you'll have a better return opportunity going forward if you can get them at cheaper prices. There's a lot of uncertainty around these tariffs, and in the short term, we're probably going to see a recession. This is a long-term opportunity, but I think it makes sense. Given all the uncertainty about the tariffs, not knowing exactly who the really big winners and losers are going to be, this is an opportunity that makes sense if you think that the tariffs can succeed. If we're going to bring manufacturing back to the United States and put a penalty tax, essentially, on foreign goods coming into this country and create this system of incentives for American manufacturers, then you want to be long that trade. If it works, you're going to make a lot of money in American-based manufacturing. And these companies are small, relatively speaking, if you compare them to the Magnificent Seven. Again, look at the market cap list. They're tiny, and these are huge companies, great companies in the industrial complex, and they're selling at a fraction by market cap what Apple Computer does, or Nvidia, or some of these others. Now the PEs are a little bit higher than I'd like them to be, but If these companies can grow their revenues and grow their earnings, there could be a substantial opportunity here for the patient investor. And think about this. It's probably time we did this anyways. We've been exporting our inflation for decades to China and Mexico. We've been using serf labor in those countries to manufacture our products. It's allowed us to keep our inflation low because we've utilized cheap labor from basically peasants, unfortunately, in Mexico, in China, in other countries, Vietnam, to make our products. When we bring that back here, I am curious to see what happens with wage inflation. Because if we start manufacturing our products here, American workers cost more money. Now, yes, we can be more efficient and we can look for other ways to improve, but it's going to cost more money. So I am very curious how that's going to work. But at the end of the day, you need to have an investment somewhere that can play the tariffs. And I think this is the way to do it. Whether you buy individual industrial stocks or you look at an industrial ETF like XLI, I think this is a bet in your portfolio that's worth putting money on. I wouldn't go huge on it, but it has a place in most investors' portfolios. Remember, you can lose a lot of money here, especially if we get a recession. It's a long-term idea, but I think this is a timely idea. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.